Welcome to our comparative analysis of two of the most significant technological market phenomena in recent history, the dot-com bubble of 1995 to 2000 and the current AI boom that began in 2023. In this presentation, we'll examine the parallels and differences between these transformative eras, analyzing IPOs, investments, valuations, hype cycles, and market dynamics that characterize both periods. Dot-com bubble overview. The dot-com bubble was a period of rapid growth from 1995 that peaked in March 2000 before dramatically bursting by 2001 to 2002. Driven primarily by internet hype and easy access to capital, investors poured money into speculative dot-com companies with minimal revenue or profits. The Nasdaq rose approximately 500% from 1995 to 2000, only to fall 77% by October 2002. A particularly telling aspect was the telecom overbuild, with $2 trillion in equity and $600 billion in debt invested in fiber optics, leading to 85% dark fiber by 2005. Despite the crash wiping out trillions in market value, survivors like Amazon and Google emerged stronger than ever. AI boom overview. The current AI boom accelerated following ChatGPT's launch in late 2022 and continues through mid-2025. This revolution is driven by advances in generative AI, massive computational demands, and widespread corporate adoption led by companies like Microsoft and NVIDIA. AI-related stocks have significantly boosted the Nasdaq Composite, which now trades at a PE ratio of approximately 34. While there's genuine focus on real-world applications like automation, concerns exist about valuation hype and capital expenditure, particularly around data center investments. The outcome remains ongoing, with speculation high, but the underlying technology widely seen as transformative. IPO activity comparison. When we examine IPO activity, striking differences emerge. During the dot-com peak years, we saw 537 IPOs in 1999, raising $95.33 billion, followed by 446 IPOs in 2000, raising $108.15 billion. In contrast, the current AI boom has seen more modest public market activity, with approximately 176 Americas IPOs in 2024 raising $33 billion and 138 global IPOs in Q2 2025 raising $8.1 billion. The key contrast is that while the dot-com era saw explosive IPO volume, with hundreds of tech companies going public annually, the current AI boom features fewer public listings, with more activity occurring in private markets. Investment and VC funding. Venture capital funding tells a fascinating story of evolution between these eras. During the dot-com peak, billions flowed into internet startups with often negative unit economics, including $69.2 billion in IPO proceeds alone in 1999. The current AI boom has seen VC funding grow from approximately $170 billion globally in 2023 to over $300 billion in 2024, with AI capturing a remarkable 45% share. In 2025, we're seeing even greater concentration, with 48% of global VC funding directed to AI, including massive single deals like OpenAI's $40 billion raise. The key difference is that dot-com funding was spread across numerous public IPOs, while AI investment is characterized by larger private rounds focused on fewer players. Market valuations and performance. Market valuations reveal both similarities and important differences. During the dot-com peak, we saw extremely high PE ratios, often exceeding 200 for some companies, followed by a devastating 77% crash from 2000 to 2002. Today, while the Nasdaq has approximately doubled since the AI rally began in 2023, its PE ratio sits at a more reasonable 34. The crucial distinction is that dot-com valuations were often based on companies with minimal revenue, while AI leaders like NVIDIA have substantial profits backing their valuations, though AI startups still echo elements of past speculation. Key similarities. Despite being separated by 25 years, these eras share remarkable similarities. Both are driven by transformative technologies that captured public imagination, leading to hype and speculation. Both required massive capital expenditure, fiber optics then, data centers, and GPUs now. Both created retail investment frenzies and what experts call 99th percentile valuations. Both featured overinvestment risks where supply could outpace demand. And tellingly, just as during the dot-com era, when countless startups added .com to their names, today approximately 99% of new startups are AI-focused. Key differences. However, important differences suggest that AI boom may have stronger foundations. Today's AI companies often have real revenue and profits, unlike the vaporware of the dot-com era. The market is more mature, with private funding dominating rather than public IPO mania, and more cautious VCs making larger bets on fewer players. Market supply and demand dynamics differ significantly. AI currently faces demand far exceeding supply, as seen with NVIDIA chip shortages, unlike dot-com oversupply. Most importantly, AI valuations appear only 1 to 3 years ahead of reality, compared to dot-com hype that was often a decade ahead of actual capability. Lessons and outlook. The lessons from the dot-com era are clear. Bubbles eventually burst due to overhype, but transformative core technologies endure and ultimately thrive. The AI boom will likely follow a similar pattern, a shakeout for weak players, but sustained growth for companies with solid fundamentals. While a correction is possible if ROI lags capital expenditure, the AI boom appears stronger than dot-com due to real adoption and revenue. The key takeaway is that while the AI boom rhymes with the dot-com era, it isn't a simple repeat. Better fundamentals and market maturity provide an important buffer against a similar catastrophic collapse.